Ever wondered why two investors look at the same stock price but see completely different opportunities? Is a 500 rupees stock truly expensive, or could it be a hidden gem? Today we're diving deep into the fundamental truth of investing. Price tells you nothing, but value tells you everything. This isn't just theory, it's the essential knowledge that empowers you to make smarter, more informed investment decisions. Let's start with the basics. The price of a stock is simply what buyers and sellers agree to trade it at in the market. It's a dynamic number, fluctuating every second based on supply and demand. Think of it as the tag on an item in a store. Value, however, is the stock's true intrinsic worth. It's based on the company's underlying business, its profits, cash flows, assets, and future potential. Understanding this distinction is crucial for any serious investor. Price is visible and often emotional, while value is invisible, driven by solid fundamentals. Consider this analogy. If someone sells an iPhone worth 70,000 rupees for 40,000 rupees, the price is low, but the phone's inherent value remains unchanged. In the stock market, the same logic applies. A low price doesn't always mean cheap, and a high price doesn't always mean expensive. It's all about its value. Here's where it gets interesting. The same stock can have different values for different analysts. Why? Because valuation is ultimately an opinion, not a fixed, universally agreed upon number. It's an informed estimate. Analysts use varying assumptions for growth rates, profitability, risk factors, industry outlooks, and discount rates. For example, one expert might project a company's growth at 10% annually, while another might conservatively estimate 5%. These differing perspectives lead to diverse valuation outcomes, even for the same company. This highlights the importance of understanding the underlying assumptions behind any valuation. Now, let's explore the powerful tools investors and analysts use to uncover a company's true worth. Mastering these approaches will significantly enhance your investment analysis. Each method offers a unique lens through which to view a company's potential. This approach values a company based on what it owns or the cost to replace its assets. It's particularly relevant for industries rich in tangible assets, like power plants, telecom infrastructure, or real estate development. Here, the value is often tied to the physical components. If a company invested 5,000 crore rupees in building manufacturing plants and machinery, cost-based valuation examines the replacement cost or the current asset value. This method works best for businesses where tangible assets directly generate earnings. For instance, valuing companies like NTPC or Coal India often begins with asset-based metrics, as their core business relies on these substantial physical assets. Also known as intrinsic valuation, this method focuses on the future cash a business is expected to generate. The core idea is simple yet profound. The present value of all future cash flows represents the intrinsic value of the stock today. This is arguably the most fundamental approach. Analysts meticulously estimate future revenue growth, profit margins, and necessary investments, then discount these projected cash flows back to their present value. This method is ideal for stable, predictable companies with consistent earnings. Think of giants like Asian Paints, HDFC Bank, or Infosys. Their reliable cash flow streams make them excellent candidates for this detailed valuation. This approach, often called selling price-based valuation, compares a company to its peers within the same industry. Instead of calculating value from scratch, we ask, how is the market currently pricing similar companies? This provides a quick, market-driven perspective. We use financial ratios like price to earnings, PE, price to book, PB, price to sales, PS, or enterprise value to EBITDA. For example, if most FMCG companies trade at around 30 times earnings and a particular company trades at 20 times, analysts investigate if it's undervalued or if there's a specific risk factor. This method is highly effective for quick comparisons, especially in sectors like retail, FMCG, and technology, where many comparable companies exist. So, when should you use which approach? The choice depends on the company and industry characteristics. Use cost-based valuation when tangible assets are the primary driver of returns and earnings. Opt for cash flow valuation when the business has predictable, stable future earnings that can be reliably forecasted. Finally, employ relative valuation when you need a market-based comparison, or when forecasting precise cash flows is challenging. Most seasoned analysts don't rely on just one method. They combine all three to cross-check and build a more robust, comprehensive valuation picture. This multifaceted approach provides greater confidence in their estimates. Let's consider a practical example. Suppose HDFC Bank is trading at 1,600 rupees. Cost-based valuation isn't suitable here, as it's a service-oriented business, not asset-heavy. Cash flow valuation works exceptionally well due to its consistent earnings and predictable growth. Relative valuation also shows it trades in line with other private sector banks. Together, these approaches confirm if the stock is reasonably valued. On the other hand, a company like DMart often trades at very high price to earnings multiples. Some analysts might argue it's overvalued based on traditional metrics, while others contend its exceptional growth potential justifies the premium. The stock price may be the same, but the perceived value differs significantly based on individual expectations and growth assumptions. This illustrates the subjective nature of valuation. The next time someone declares a stock expensive or cheap, remember, price is merely a number. Value is the compelling story behind that number, revealing a company's true potential. By understanding these fundamental valuation approaches, you gain a powerful toolkit to analyze investments with greater insight and confidence. Don't just follow the crowd, lead your own investment journey. Start practicing these valuation techniques today. Pick a company, research its financials, and try to estimate its value using one or more of these methods. Share your insights in the comments below, and let's continue to learn and grow together. Your financial future begins with informed decisions.